Yeah, not a worry. Thank you, Jen. I appreciate it. And again, happy Friday, I guess is probably the best way of putting everyone. Great presentation by Johnny. Absolutely. I think that insider stuff that he talks about is really something to take serious. So certainly would encourage everyone to take a look at that as well. Anyway, we're going to talk about the Santa Claus rally. Who in here believes in the Santa Claus, in the Santa Claus rally? The thing is that the Santa Claus rally is real. And so today what I'm going to show you is my repeatable strategy for trading the market. So you'll need this not only into year end, but definitely also when it comes to 2019, because I really believe that the stock market has shifted its posture in terms of directionality. So just keep that in mind as we go through. I think there might be a typo on your Santa Claus has an E in it. Anyway. All good. We will talk about the Santa Claus rally either way. So let's have a look at this a little bit. So how has your portfolio performed over the past couple of months or so? This is probably not something everyone wants to admit to, but I think it's really important to understand and that you have to be honest with yourself. You know. So how many of you have gotten hurt in the recent stock market correction? Everyone a little bit? Yeah? Again, nothing to be ashamed of. I just want to show you a process today that not only helps us to really find these opportunities into year end, but certainly, like I said, also going forward. So I'm very excited for this. This is something that I have up until recently only allowed a very sort of inner circle of people to kind of understand. This is stuff that I learned on the sell side and on the buy side where I've worked all of my life until I started my own company. So I'm excited to share this with you. So I received a short signal in the technology stocks. It's the XLK is the ETF that represents the S&P 500 technology stocks. And the sell signal here is represented by this red little down arrow. This happened on October 4th, 2018, so about a month and a half ago or so. And once I saw that happening on the sector level, that was, to me, was the alert that I needed to start looking at stocks within this sector and see if there might be an opportunity to do something on the short side or at least to sell something. So what I came across is shares of Microsoft, and you can see literally on the same day, this was October the 4th as well, did we also receive a sell signal on the stock. That's this little down red arrow. You can see sell short signal. And Microsoft proceeded to drop 10%. So what I'm going to show you today is this process by which gauging what's happening on a stock or sector or group level, stock sector or group level, one has much better odds of picking winning stocks as opposed to doing it the other way around, all else being equal. To show you how this kind of a process works, this is my year-to-date performance. The green line is the portfolio. You can see it's up 70%. That's 70% versus the S&P 500, which has kind of snaked its way back to flat for the year. Actually, it's kind of down on the year. And just to be clear, I'm not saying this to show off. I'm just trying to show you that what you can do in the markets if you have a repeatable process, particularly one that I'm going to show you here focuses on looking at the big picture, top down first, looking at sectors, and then ultimately at the stock market. So we're going to walk through this step by step. So by the time we're done here, that you really have something to sink your teeth into come Monday morning when really the players return back to the stock market. 3 major struggles for traders and investors. What are they? Number 1, I think information overloads. A lot of people are flooded by information. Number 2, no repeatable process, and a lot of people just have too many tools. What I find is that people have no process. They feel lost amidst all the information. Does anyone here can anyone here relate to at least one or maybe all 3 of these points? Raise your hands. Yeah. So I'm going to address all 3 of these problems here for you today to make sure that we extract these issues and you can start making this work for you. It's really not that hard, folks. I promise you. And I'm going to show you exactly step by step how this really works. So quickly back to the Santa Claus rally. how would you like to make money from now and the year end, regardless whether we get a year-end Santa rally? And I can tell you a lot of people right now, a lot of fund managers, a lot of family offices, a lot of hedge funds, everyone that I talk to is really, really kind of counting for a year-end rally for their performance, because not a lot of people are doing well this year. Why? Well, I just showed you why. The S&P 500 has basically had a very snaky up and down move all year long. So I'm going to show you not only why there is a good chance for a Santa Claus rally, or a year-end rally, I should say. It's a better term. But also the how, of course. It's very important. So, of course, the presentation title is Prepping for Santa Claus Rally. I'm going to show you this repeatable process and how you can make this work, like I said before, not just at the year-end, but also in 2019, because I really, really think that the stock market has shifted its posture quite meaningfully as we've seen over the past few months, and I think the directionality or the momentum in terms of directionality we've seen over the past number of years is probably peaked. So it's going to get much more difficult. You really need to have a process now. You can't just blindly buy any single dip out there. So let's talk some numbers, because I think giving people a little bit of background in terms of the reality of the statistics is always interesting. So the year-end rally statistics are favorable, is I guess the best way to put it. So this addresses the why. Why do we have a good chance of seeing a year-end rally? Well, on average, December tends to be one of the best performing months of the year for stocks. And I say on average, right? Just to be very, very clear, this is an average number. In fact, on average, the S&P 500 tends to be up around 1.5% to 2% in the month of December. And even if December is not an up month, it's usually not a horrible month. Now, again, this is an average number. Not every December falls into this, but for the most part, it's like that. It's something like 75, 80+% or so this is what comes to fruition. So underperforming fund managers, as I alluded to before, are really the ones that are just about now have the water kind of, rising very, 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 very rapidly. And they are going to be forced real soon to start chasing or buying some of the better performing stocks and sectors out there. So, for example, this year we've had consumer discretionary stocks and actually technology stocks, despite the recent drought, still being very good. So that's really, if you really dig down into it, that's a lot of the conversations I'm having. That's exactly what's happening right now. People are getting very giddy because if these guys are dramatically underperforming their benchmarks come December 31st, a lot of them are really at risk of losing their jobs by the time we get into the first quarter or so of this coming year. And they don't want that to happen, so they're probably going to chase these stocks, even if it's only for window dressing purposes. And then there's this natural tendency for market to rise when there's sort of a quiet market. So what you tend to see, certainly in about 3/4 of the month of December, you just tend to see fewer market participants. So that gives much more of the natural buyers in the market an opportunity to float the market higher. And your natural buyers are your pension funds, your insurance companies, all these kind of companies that are net buyers of stocks because they have to put capital to work that they get in from premiums and so on and so forth. To give you a chart on this is what the seasonal chart of the S&P 500, this is a 37 or so year history, I think. This is what it looks like. So in December, you can see that's the green arrow indicating the month of December. We tend to have a very nice up month. Again, it's in the S&P somewhere around 1.5% to 2% or so on the upside. That's interesting to know. And by the way, and this is interesting through the lens of if you want to look at seasonals, the November-December period actually kicks off the best 6-month streak for stocks of the year. So through about the month of April or so or thereabouts, we tend to have very good seasonal. So you can see it kicks off in November, December, and then it goes right through April, May. And this is an average number. It's not exactly like that every single year, of course, because obviously November or October, and actually November so far as well is actually a down month. But again, the month is not over, so we'll see what happens. So I hope this statistic gives you a little bit of an idea of what we're kind of up against here coming into the month of December. Just a couple of words on myself in case you've never heard of me. I have originally come from the sell side, meaning that I used to be an investment banker, places like JP Morgan and buy-side prop trader and portfolio manager, places like hedge funds and family offices and things like that. And I'm now proud to say that I've had my own company for 9 years. We're doing advisory, managing money, all that kind of stuff. And I'm very fortunate to be able to pass all this knowledge on to my direct clients and the broader audience such as yourself. So when I look at the market, I look at it through the lens of what is the best reward to risk that we can get in a risk-adjusted way. And that sounds like a lot very complicated sort of wording, but it's actually very, very, very simple and straightforward if you really start understanding it here over the next few minutes or so. So now that we've talked about the why we could see, and why we still have a very good chance of seeing a year-end rally, let's talk a little bit about the how. How are we actually going to capitalize on a potential year-end rally, and ultimately, again, really in any direction as it comes into 2019 and beyond. So I'm going to show you the exact same strategy that I employed to trade the markets with a simple and repeatable process. I think repeatable is very, very, very important. And it all has to do with following the money in a very simple and repeatable manner. So here is my first question for you today. Who moves markets? Is it A, institutional investors, or B, retail investors? If you want to type in the answer, is it A or B? A, institutional investors, B, retail investors. Who do you think moves the markets? Correct. I'm seeing all correct answers. That's very good. Of course, it's institutional investors. That's not that retail investors are bad people. It's just that the institutional investors have a lot more money, at least any given institution on its own for the most part. Exactly. Thank you very much, folks. I really appreciate it. And what a great crowd here, by the way. This is so nice to see you guys all participating. So the other thing we need to understand about institutional investors, and by the way, this is the kind of trading floor that I used to work at right here, this kind of a desk. The institutional investors don't just buy one stock at a time, for example. They don't just sell one stock at a time. What they do is they buy and they sell themes. So if you ever work at an institutional desk, for example, when I used to work at JP Morgan, all the orders, everything, it wasn't just one stock or one bond. It was always themes. So a hedge fund would come in, for example, or an insurance company would come in, and they will say, okay, we think now technology stocks are going to go higher. They're not just going to buy one stock, one tech stocks. They're going to buy a whole basket, a whole variety of them because they believe in that theme. Okay, and so keep that in mind as we walk through the presentation over the next few minutes, because that's really, really important to understand. So let me repeat this one more time. Institutional investors, they are the ones that move the market, but they don't just buy a single stock. They will buy themes. Okay, so if you want to see moves such as a 35% rally in a stock like Intel, options rallying 400%, or you want to see moves taking place like a 40% rally in a stock like VMW and the options rallying 550%. In order for those kind of moves to come to fruition, you need institutional sponsorship. Unless real money is flowing into a group of stocks, then any move higher is likely not sustainable for very long. And I'll tell you, we've seen a lot of real money selling over the past couple of months in the stock markets, meaning that the recent rout we've had is probably something that's not going to get us right back to all-time highs anytime soon. Does this make sense, folks? This is really, really important to understand. The institutional sponsorship of it all is really, really crucial. To take this to the next step, we need to understand that stocks as an asset class are really highly correlated. Who in here has ever heard before, by show of hands, that stocks are a highly correlated asset class? I hear that almost never. I literally, like, if you go on CNBC and again, this is not to knock, by the way, any media outlet out there, almost no one ever talks about this. In other words, what do you think happens on a day when the S&P 500, say, rises 1%? What happens? What do most stocks do on that day? Right, most stocks probably go higher. And conversely, if the S&P 500 were to drop 1%, most stocks are probably going to drop that day, right? So now that we understand the positive correlation among the stock markets, we are ready to take this to the next level, because that correlation of stocks is not something that positive correlation is not something you see in many other asset classes. For example, you take the commodity complex. If the price of oil goes higher, what does that mean for the price of pork bellies? They're both commodities. It probably doesn't mean a whole lot for the price of pork. Its correlation isn't there, or at least the positive correlation isn't there. But the stock market as a whole tends to act as one animal. This is a simple chart that I cut of the S&P 500 sectors just to illustrate this and give you a bit of a visual aid to get your head around this, and you can see how nicely the stock market tends to correlate. Most sectors are moving up and down together. Every once in a while you get an outlier, one of them completely decoupling, but that's actually where there's a lot of opportunity, and we're going to get to that here shortly. So how do we make money in stocks if everything tends to move up and down together, Serge? That's probably what you're asking. Well, there's a little something called sector and group rotation. A little something called sector and group rotation, and we're going to get into that here in just a minute. So stocks are a highly correlated asset class. I just told you, right? 60 to 80% of stocks move up and down together, right? So on any given day where the stock market is up at least a little bit, most stocks are probably going to be up. Right? Not every stock, I'm not saying 100%, but most stocks will probably not be down very big, bearing any major idiosyncratic news like earnings news or something bad or something really good happen to a stock. To put this in other terms, or in other words, 8 out of 10 stocks move up and down, will rise in any given bull market or any given bull trend, regardless of duration. 8 out of 10 stocks will fall in any given bear trend, and 8 out of 10 stocks will chop back and forth in a sideways market. Make sense? And now we're ready to take this to another level. If we take all this together, I'm here to tell you that 80% of your portfolio returns can be explained by your portfolio allocation. So I showed you my portfolio before that's up 70% year to date. That is entirely due to the fact that I've picked the right sectors and not the right stocks to trade. Okay, I've focused on the sectors where the money's been flowing as opposed to trying to find the single best stock. In other words, being allocated to the right asset class or the right sector or the right industry groups makes all the difference. So only about 20 to 30% of a stock's directional move empirically has to do with the stock's news itself, on average. Think about that. Only about 20 to 30% of a stock's move has to do with news around itself and how good or bad it's doing. The rest is really due to how its sector or group of stocks is doing, because institutional investors are pushing that entire sector up or down. Does this make sense, folks? Give me a yes if that makes sense. Excellent. So what you need to do is you need to start putting the odds in your favor. Really, really important. And just finally put the wind at your back. Perfect. Getting a lot of yeses. Love it. So then how do we know when the year-end rally is ready to start and if it's ready to start? Well, what we need to see the important sectors, the important parts of the market. They must flip to at least short-term bullish. And by the way, they haven't done that yet. They haven't done that yet, and I'll show you that in a minute what the current state is right now. They haven't done it yet. And on top of that, once that happens, in order to actually buy a stock, we need to then see if that stock is also doing what the group is doing. Okay, so I'm going to show you how these trend changes can be determined time and time again to keep you reaping profits and staying on the right side of the market. Sound good? So let me invite you to explore a better way to trade stocks, a much more sane way, less nervous, okay, much steadier returns, and really, quite frankly, just a more sensible and more sustainable way to steady profits in the stock market. You guys ready for this? Let's talk about it. It's called the repeatable process, is what I call it. And the repeatable process really starts with a big picture. And the big picture, I don't mean you have to start taking economy classes and becoming an economist. In fact, I think that might be detrimental to your success as a trader. Not to knock the profession of economics. I think that's very, very good. But you want to start with the big picture. What does that mean? Well, that very simply just means what's the stock market doing? Is it going up, down, or sideways? Very simply put. Once you have an idea there, then we start looking at the sectors or the industry groups, right? Again, I'm showing you a desk of an institutional. Actually, I think this is actually the Bloomberg company that this trading floor is. But anyway, or news floor. But the point is, we need to look at sectors and groups because that's where the institutional investors are allocating money to. Institutional investors, yes, they're buying individual stocks, but they're not buying individual stocks because they like those individual stocks. They like the themes behind them. Okay. And then thirdly, once we've understood what's happening in a sector or group level, then move into individual stocks, ETFs, and ultimately, if you want to, then pick an options trade based on that. That is, of course, something you can do as well. Sound good? So let me give you a couple of visual aids around this, because I think a lot of time, particularly in the U.S. market, there's such an epidemic of just looking at single name stocks with complete disregard as to whether that's in the stock's industry group or sector is being actually being bought or sold, accumulated or distributed by fund managers, that I need to give you a bit of a visual around this. The visual is very simple. So this is kind of weird, okay? So just bear with me. But I kind of constantly envision myself sort of being this hawk, like kind of flying above ground, looking down at the stock market. I know this is a bit loony, but this is kind of how I feel. But what it helps me to do is kind of look down at the stock market and see all the different sectors. And I see these sectors moving quite orderly. One sector is gaining, taking over the other one. One of them is falling back. And that's really what I'm seeing is I'm seeing the stock market moving in a much more orderly fashion than you would think if you just look at, say, the S&P 500 itself on the surface, or if you look at all the individual stocks, okay? So we're looking at the broad stock market trend first, then most importantly, we're looking at the sector groups, and then once we see something happening in the sectors and groups, we're looking at the individual stocks or an options plays. Another way of looking at this, and I'm just trying to give you a couple of different ways of looking at it so you get this as quickly as possible right now. The sector and group rotation game is kind of like a car race. Okay, I don't know how many NASCAR or Formula One fans there are out there, but this is kind of one way of looking at it. So the stock market is like a car race. Like one group of stocks will tend to lead, right? Kind of like the car here in the front, number 10 or whatever that is. And then at some point, it's getting passed on by another one. And then maybe this sector in front here, maybe that's technology. It starts dropping back as, let's say, utility stocks start catching up, right? And the key here to finding the leading sectors, the key is finding the leading sectors or groups on a continuous basis, right? Because the leadership usually doesn't last for very, very, very long. It always rotates. And this strategy that I'm showing you here, folks, works in any market environment. And I know a lot of people say that. I can promise you this really is the case. Why? This isn't just a bull market strategy. This isn't just a strategy for bear markets. This isn't just a strategy for markets going in circles. This is how the stock market works. By definition, money is always trying to find the best opportunity. And so institutional investors are always looking for the best reward to risk. And thus, there's constant flow in and out of the stock market in different sectors, as there is between asset classes, right, between bonds and stocks and so on and so forth. So going back to that example just real quick that I showed you before on October 4th, when I got that sell signal in the technology sector ETF itself, that's the XLK. For those of you guys familiar with that, this is just one of the ETFs making up the 11 sectors of the S&P 500, giving us that down arrow on October 4th. And then we started moving, digging deeper, looking at stocks within that sector, within, in this case, this ETF, that are also giving us sell signals. We came across Microsoft. Sure enough, on that very same day, it printed a red down arrow to us, indicating a short signal or a sell signal at the very least. And of course, the rest is history. Stock ended up dropping about 10%. So now that I've given you a little bit of the why and the how, let's go a little bit deeper and start working through the 1, 2, 3 step process. Because the 1, 2, 3 step process is really, really important in order to get into that rhythm. I gave you, about 25 minutes ago, I gave you the three issues that I see most investors have. And one of them is that people have no process. It's probably the biggest problem that people have. They have no process. You have a broker tool out there with, hundreds of indicators on there with flashy charts. You can draw lines and circles and smiley faces, whatever you want on those charts, but no one's teaching you a process, right? And so what this is all about teaching you a process that you can actually use. So we start with step number one, that's the market environment. Is the stock market bullish at any given point? What is it right now? Is it bullish? Is it bearish? Or is it choppy or volatile? If anyone would have a guess, what do you think the stock market is doing? Is it bullish, bearish, or is it choppy or volatile? Any guesses? To me personally, we are bearish very short term, but really we're kind of choppy and volatile is kind of where we are right now. Yeah. Excellent. So once we understand this, we're going to look at step number two. This is the sectors and groups, this trend and rotation. So which sectors are leading or lagging? I'm going to show you guys that right now. Which sectors are leading, which are lagging? Are there any breakouts or breakdowns taking place? I'm going to show you guys a couple of interesting things that just happened on a signal based on Wednesday. And then step number three, once we have all this together, we're going to be looking for stocks or options with bullish signals in the bullish sectors, or the sectors that have at least just recently turned bullish, because that's where you're going to get to generate the most alpha. Or you can look for stocks or options with bearish signals, which is going to be mostly taking place in sectors that are bearish or at least have recently flipped bearish. In order to make this the smooth and repeatable process that it is, what I do is I track the S&P 500 sectors and some industry groups, the ones I consider to be the most important, and I monitor the trend changes. And you guys, if you want to just take a second, you can write these down. You can take a picture with your cell phone or iPad or whatever you have in front of you, or God forbid you have an actual camera, a real old school camera. Take a picture of this so you can kind of see what the ones are that I am tracking for the most. But there's a few more, but this is kind of the big thing. So what I'm looking for every single day, week, month, quarter, years, I'm looking for trend changes. And this is not a current picture, by the way, so this is not a current suggestion or anything like this. I took this picture a couple of months ago or something like that, or a few months ago. But once I see those changes taking place on a sector level, right, on the sector level, in terms of trend, then I start looking for individual stocks within any given sector. Particularly what I'm looking for these blue rows. You can see, for example, on this specific day, whenever I took this picture a few months ago, the information technology or technology sector had turned to short-term neutral from short-term bullish. So that would have indicated to me that day to go over and look at stocks within that sector for opportunities, probably on the bearish side. So let's follow the process. Because without the process, like I said before, there's really no way to make money in the market. Let's start with, I think I'm going to give you 3 or 4 examples right now, because I want to walk through actual examples of trades that I have done over the past few months, so you can see that this works. And then we're going to actually look at the market in real time a little bit to kind of give you an even better idea of how all this works. And this is also exactly how we're going to be gauging whether there's a year-end rally starting or when it actually starts. So let's start with example number 1. At the time, this was in late June or I think early July or something like that this summer, and the broader stock market trend was to the upside, right? Wouldn't you agree? Well, what we noticed at the time is specifically in late June, the healthcare sector, the XLV is the ETF or the exchange traded fund, or the index that tracks the healthcare stocks. It had turned from neutral to bullish. And you can see this happened right here, and the healthcare stocks rallied about 15% as institutional money started really going into this part of the market. Well, as I was alerted to this in late June, I started looking a little bit closer at the healthcare sector, at the individual stocks. And I came across shares of Pfizer, ticker symbol PFE. And lo and behold, we got 3, not 1, but actually 3 buy signals in a row in this stock in late June. You can see them right here. That's these 3 little three little green arrows, 3 buy signals, and the stock ended up rallying 25%, as you can see. Now again, it's important to understand, how many of you have ever bought a stock and you had every reason in the world to think the stock's going to go higher, but it didn't go higher? I mean, obviously everyone's done that, right? I've done it about a gazillion times. But most of the time, the reason why that's happening is really because it's not being accumulated by big money institutions, right? Because there's no real buying happening in that sector that it belongs to, or that industry group that it belongs to. Let's look at another example. So you can see very nicely how this works from a top-down perspective. The next example is in the energy sector. And at the time when I was looking at this, the broader stock market was trending higher. This was still in the first half of September of this year, first half of September. And what I noticed is I got a signal in the XLE, which is the energy sector ETF, the XLE. I got a buy signal, or a flip to short-term bullish. Short-term, my definition is a few days to a few weeks at least. Few days to a few weeks is usually the time frame we're looking at here in this specific time frame, the short-term. And you can see this happen in the first half of September. Again, you can see it right here. This is the buy signal we got, or the meaning that the sector went from short-term neutral to short-term bullish. Well, I was alerted to this, and certainly I came across shares of ExxonMobil. This is ticker symbol XOM. This also happens to be a major part of the energy sector. And you can see here as well, in the first buy signal flashed in mid-September, and the stock ended up rallying 25%. Again, this is happening because money was being plowed into the energy sector, at least for a trade, a few days to a few weeks. I could have had the best setup in the world, but if people weren't actually committing capital to that sector, this stock would probably not have gone higher for the most part. Let's look at another example. And actually, we're going to stick with the energy sector, because you guys are saying, oh, well, that's easy in hindsight. But let me just show you how it worked exactly on the opposite side. So this is now taking place in the early October period. In early October, the broad stock market had just turned short-term bearish, which we'll get back to in just a few minutes. But also notice that the energy sector, this is the same ETF, the XLE ETF. Again, this is the energy stocks, the XLE of the S&P 500, had turned short-term bearish. You can see the red down arrow taking place here. And this is actually, this comes from my screen. I printed this. You can see a down arrow printed on early October, whatever that was. I think that was October 4th or something like that. And the energy sector turns bearish. Well, I dug a little bit deeper on that very same day, and I came across Chevron, ticker symbol CVX. And you can see bearish signal. Why? Well, because the whole sector was being sold. And if you look at the energy sector, by the way, today the energy sector is down another 3.2%, largely because of what's going on in the price of oil. And this stock ended up dropping 15%. So are you guys starting to see the repeatable process here? Are you starting to see how, if you look at the sector level first, you can just really start to have a good chance of, a really much higher chance of making money? Let's look at one more here. This is now looking at industrial stocks. And what you see here is that this was actually just a couple, I think this was just a couple of weeks ago, early November. And what happened here is the stock market was still bearish. The industrial sectors, or the industrial stocks, were still bearish. And so I wanted to see if there are opportunities to short an industrial stock. So sure enough, I came across the ticker symbol BA, which is the Boeing company, right? This is the XLI. You can see the sector that it's in, and the stock itself is also short-term bearish. And on the 13th of November, that's about a week and a half or something like that ago, you can see the sell signal that I received right here. That's this little red down arrow, and the stock ended up dropping 15%. Okay, so it's not because I have something bearish about the company. It's because that entire sector and group was under distribution, and actually continues to be still as of right now. So the point here is, folks, that markets don't trade in a linear fashion. This sector and group rotation is the norm. It's not the exception. That's why this strategy works in any market environment, because it is how the market actually works. Just to give you one more little chart here to kind of sink your teeth into, this is the S&P 500, the SPY ETF chart from earlier this year. And I just want to give you another point of reference to kind of really hit this home. This is where my trend scanners went bearish right here in early February. Then it flipped for short term. Then it flipped back to short term bullish for a bit, and then right back to short term bearish. So you guys can see how this works in the actual broad market as well. So the way I actually track this, and to make this a repeatable process, super easy and straightforward to follow, what I did is I actually implemented and had this programmed first and foremost for myself. It's called the Market Rover Pro, and it's a dashboard that has all this whole process embedded. And it's web-based, and it works on your PCs and Macs and all that kind of stuff. But really what it is, it's the 1 through 3 step process that I just showed you over the past 35, 40 minutes so far. And you can see it's nicely labeled step 1, 2, 3 on the left-hand side. Step number 1 being the broad market. Is the broad market bullish, bearish? Is it choppy? Step number 2, what are the sectors doing? Which sectors are being bought? Which are being sold? Right? Where are the opportunities there? Once we have that, we then start looking at individual stocks according to what we're getting on the sector level. So you can see here, this is step number 1. It tells us whether the market is bullish or bearish in which time frames. For short term for me is usually a few days to a few weeks. Medium term is usually a few weeks to a few months, and then longer term is a few quarters to a few years. And again, this is not a live chart here. This is I cut this chart a few months ago. I'll show you the live chart here in just a few minutes. And then we move into the sector and group changes. Like I said, right? You start looking at the sectors and groups and see which ones of these are bullish, which ones are bearish. And I'm going to show you guys the live charts here right now. And then once we have that, we then start digging into the individual stocks and seeing if there's opportunity right there. So let's go into some live charts in a second, but I wanted to also show you some of the signals we've had just recently off this, again, using the top-down process. For example, in shares of Goldman Sachs, this comes straight from the Market Rover Pro. These are the 3 recent signals we had. We had a sell signal here, and another sell signal here. And this is all based on what's happening on a sector or group level as the financial sector of stocks started going to short-term bearish. We got these signals in shares of Goldman Sachs. Then AIG, this was a stock that got very oversold. We have these little diamond-shaped little nuggets here telling us the stock is very oversold. For a bounce, great, it happened. Then we had a sell signal, and we just got another small buy signal just a few days ago. Or here in shares of Box, this is a technology stock. This is Dropbox. I don't know if anyone uses this. You can see a buy signal here, then we got some sell signals and a streak of sell signals in late September, actually before the market really started dropping. Again, based on what's happening in technology stocks as a group, right? Technology stocks stopped going higher, started turning short-term bearish, and then, of course, these signals started to come out in the individual stock. Tell me if this makes sense. Yes? Excellent. Okay. So let's have a live look at all of this. And for that, what I'm going to do is I'm going to actually bring up the Market Rover Pro on the screen for you. And there's a couple of things I want to show you. So first of all, let's just skip right to the sectors and groups for a minute. What I want to show you right away is the overview that you can get by using this process. Whether you use this tool or not, the point is the overview that you need to get. So right now, these are all the sectors and the groups. And you can see a lot more red, meaning bearish on the short-term side, and short-term neutral than short-term bullish, right? So most things are actually short-term bearish or neutral, with just a couple of these sectors and groups being barely short-term bullish, by the way, and I mean barely. So you can see the very quick overview you can get right away from that. So let me show you something that happened just on Wednesday. On Wednesday, you can see these things in blue, these columns changed direction in one time frame or another. In this case, the utility stocks went from short-term bullish to short-term bearish on Wednesday. How do we, excuse me, to short-term neutral, my apologies. The utilities went from short-term bullish to short-term neutral. How do we know that? Because this little red nugget here is, well, it's neutral. It's sideways, right? And it's filled. So given that, what I want to do now is I'm going to click on this row here. And as I clicked on that, all the utility stocks just started filtering down here. That's how simple that is. I simply clicked on that and all the utility stocks filtered down here. And now I'm looking for sell signals. Why? Well, because utilities just went from bullish to short-term neutral, so I want to see if there's sell opportunities. So I'm going to click on this column here, which gives me the B2 reversal signals. And you can see how, for example, in this case, like 6 or so stocks are coming up. Well, let's just go with the one on top here, which is Amarin or AEE. And I'm going to zoom in here, and then you can right away see the recent signal. We had a buy signal here, but we just on Wednesday got this sell signal here in utilities in this stock. Again, following this top-down process, folks, what were we doing? We're looking at the sector first, then we're looking at the stock. Does that make sense? Lovely. Another opportunity that I'm going to quickly show you is something that's happening in the gold arena. And I'm not a big gold trader, but if you look at the GLD, which is the gold ETF, you can see that it actually just on Wednesday went to short-term, from short-term bearish to short-term neutral. Well, one of the go-to gold-related stocks that I like is something called NEM. It's Newmont Mining, which is actually short-term bullish. And there's no signal yet, but just so you know, it's something I'm watching. And if you want to look at the last few signals in Newmont Mining, just so you know, sell signal and the stock dropped. Sell signal and the stock dropped. Sell signal, sell signal, sell signal. Okay? So you can see that this stuff really, really works, but it really has to do with making sure we understand the top-down process. One last thing I'm going to show you quickly on here is our oversold and overbought parameters. So what I'm going to do is I'm going to click on this called VX, which stands for Vertical X Pro. And what it's bringing up today right now is two stocks that are very oversold but not quite ready to bounce yet. But they're going to be, I think, very soon. One of them is Ross Stores and the other one is Target. And you can see how these stocks are very, very oversold given these green colored little diamond shaped little nuggets there. Okay. Now that we've looked at the top-down approach, and again, keep in mind, this is where the market is right now. So in order to see a Santa Claus rally, we have to see at least half or a third or more of these sectors turn from short-term bearish to short-term neutral or bullish, particularly the important sectors, the big ones, the financials, the technology stocks, which make up 21% still of the S&P 500, okay, and probably also the consumer discretionary stocks. One thing I haven't told you yet is that the process that we use with the Market Room Pro also includes market commentary and live weekly webinars. So what we do in here is I go in and every single day I give you a commentary of the best of what's happening on a sector level and some of the best ideas based on that sector level. And also we do live weekly webinars, which I'll talk about here in just a minute. And lastly, and I'm not a big fan of talking about something that's not quite there yet, but coming in December, we're going to have literally pop-up trade ideas, just so you guys know. So all these trade ideas, the ones that are valid, they're literally going to pop up on your screen, given that top-down process. So if a sector goes, let's say, from bearish to bullish, it's going to not only be viewable the way I just showed you with on the watch list here, but it's literally going to pop up on the screen for you. So let's talk about the top-down process again. So a year-end rally, in my opinion, still has really good odds of happening, but we need to see sectors and groups of stocks, particularly the important ones like technology, consumer discretionary, and financials. I'm going to say this again. Particularly technology as a sector, consumer discretionary, and probably financials, right? These are the three sectors of the market that probably have to start getting a bid. Otherwise, a year-end rally doesn't really have much of a chance. So that's my tip here in terms of the year-end market rally. But I want to invite you to trade the 2018 year-end market and also into 2019 together, because like I said before, the market has shifted. The market structure has shifted. We are seeing a shift in the landscape in terms of interest rates, and more importantly, in terms of growth in the economy. Okay, and that's going to make it much, much, much more difficult. If you just have a simple buy and sell strategy, buy and hold strategy, or buying the dip strategy, that is probably going to stop working. That's why you need to start looking at group and sector rotation. And the way that you can do that with me is by following along with the Market Mastery course and the Market Rover Pro. So what this is, our Black Friday offer, Black Friday special, I should say, is the video course, which is the Market Mastery, which is lifetime access to this. And you also with this get 90 days access to the Market Rover Pro with the daily commentary, where I give you the best sectors and the best stocks that are giving us ideas to trade. Weekly live market scanning webinars every single week. We actually just moved from monthly to weekly. So it's going to be happening every single week. We sit down, we go through the best ideas, scan them, take any questions, go through the process, and keep you on the right side of the market. The Market Rover Pro has embedded into it the B2 reversal indicator, which is our buy and sell signals, the Vertical X Pro indicator, which includes the overbought, oversold conditions where you have tremendous opportunity. And even if you're a day trader, there actually is a indicator embedded in there as well for something called gap trading, which is absolutely fantastic. Also, you're going to get access to the top performing chart patterns ebook, which I'll show you here in just a minute. All of this is $497. You go to the steadytrader.com/master. The value here is way over $2,000. So with $497, gets you, again, the video course, teaching you the entire process here, keeping the right side of the market, lifetime access to that, and you get 90 days access to the Market Rover Pro. Excellent. So all you have to do is go to the steadytrader.com/master. Let me talk about a couple more things. Now, the course, again, that you get lifetime access to covers a lot of stuff around this entire strategy I showed you, including mastering the top-down approach, right? So you can really learn how to zoom into the market opportunities. You can learn what moves the markets actually and what to focus on, and stop guessing, because the guesswork doesn't really work over time. It's going to teach you all about stock, sector, and group analysis, a 3-step process to the trade, when to trade a stock as opposed to an option or an ETF. Has anyone ever wondered whether you should trade a stock or an ETF or an option? Has anyone ever done that? Right? It's going to teach you how to properly set up your charts, position sizing, and key technical patterns as well. Like I said before, you're also going to receive access to my best-selling ebook. This is called the Trader's Guide to Top Performing Chart Patterns for Stocks and Options. Again, this is yours to keep as well. This is included here. This also includes a trading plan worksheet, and it includes a trading and investing glossary. The next live weekly webinar for the Market Rover Pro scanning session is next week. Again, we do these every single week. So you get access for 90 days right now for this. And again, you also get the course. The course you get to keep forever. Over the next 90 days, you're going to learn so much with this, guys, just with our weekly webinars alone. Forget even the tool itself. That's going to be awesome. But even just these weekly webinars, you're going to learn so much. It's at 11 a.m. Eastern and 8 a.m. Pacific, and it's always recorded. So if you can't make it one time, you do not have to worry. It's always going to be there for you. So what are we going to go through in these webinars? Well, we really go through the entire market analysis using the Market Rover. It's the live 3-step process market analysis, live market scanning, idea generation, all the Q&A. Ask us anything you want about the markets. We usually go through about 15 stocks or more. It's probably usually like 20 or 25 in 30 minutes through the entire process, ETFs and stocks, just as I just showed you. Sectors, groups, stocks, and even option selection once we get to that. So this is $497. You go to the steadytrader.com/master. 2 more quick things, and I'll take some more questions here if in terms of the top-down process. A couple of things I haven't mentioned yet. Number 1, let's go back to the highlights here in just a second, but I want to show you also the Market Rover Pro actually works on your tablets, and if anyone has a tablet, and it also works on your smartphones. So you don't have to be tied to your PC or your whatever you have, your Mac, whatever, your laptop. It works on your smartphone, and it works also on your tablet. So you're good to go on that. Yeah. So again, some of the Market Road Pro highlights, again, it's the market trend scanners, so you know exactly when sectors move from bullish to bearish. Then you get the signals from the beta reversal indicator, nailing the bullish and bearish reversals. Then it also includes the overbought and oversold indicator, even the gap trading, which is a day trading strategy, which we'll teach you as well in these live webinars. The daily market commentary, where I tell you the best ideas that are happening in the market based on this process, and of course the weekly live market scanning session. So by the time these 90 days are over, when you take this offer, you're going to be in an amazing position to really start not only trading the year-end rally here right away, because we're going to start talking about next Wednesday and getting you prepped for the potential year-end rally and really focusing on it, but also as we get into 2019 to really stay on the right side of the market. So again, this is my process. This is what I've developed over the past 21 years as a trader, money manager, advisor, educator, everything that I do. And it's great. It's the top-down process is really ultimately how you're going to make money in the market, because you need to be able to follow where the money is flowing. So yeah, so the trades. So Edwin's asking about what kind of trades are coming up. Well, the trade alerts, as you just saw over the course of the presentation here, are always going to be coming on either single name stocks or ETFs, and then you can go deeper and extrapolate and see if you want to do an options trade, which is something that we will always talk about in the weekly webinars as well. So for example, if you go back to utilities, let's for example look at like Goldman Sachs. Okay, it's just a stock that I remember I had a few trades on recently. Okay, these are just the most recent signals in Goldman Sachs. Okay, sell signal, sell signal, sell signal. Again, it's coming based on the sector. So when you get a sell signal in the stock, a lot of times you'll also get a signal in the actual ETF itself, right? So you can take a signal in the ETF, but you can also trade the stock. Now, if you trade the stock, you can do an options trade around it, and that's also where we're going to guide you through in the weekly webinars as well. Does that make sense, Neil? Edwin, all you guys asking? Yeah. The gap trade is a day trading strategy that's included here. I don't have enough time, unfortunately, going into it right now, but it's also something that we cover in the webinars. Thank you, Yudao. I appreciate you thinking this is an excellent presentation. Thank you. Yeah, so it's really based on long and short signals. If you want to trade that, not everyone wants to short stocks, but you can buy put spreads if you want to trade on the short side. It's just based on what's actually happening in the market, right? Excellent. Yeah. So going back to the offer real quick, and I know my time is just about up here, but again, what you're going to get here is you're going to get the entire course, the video series, teaching you the top-down approach, lifetime access to that. You're going to get 9 days access to the Market Road Pro with market commentary, right? That's in the Market Road Pro every single day. The weekly live webinar scanning sessions, the beta reversal indicators included in there. The Vertical X Pro is all on the platform, the gap trading indicator, and also you get access to the top performing chart patterns and ebooks. So again, it's the top-down approach, folks. Oh, and by the way, one more thing. I just mentioned it before. Pop-up trade alerts are literally going to come on board in a couple of weeks from now. So they're not there yet, but they will be there. They're almost done in December. So not only are you going to see the trade alerts happening like I just showed you, but they're literally going to be popping up on your screen as they come available. So that's I'm super excited about that, and I hope you guys will be joining us there. So I'm looking forward to trading the year-end rally together with you. Again, we do the weekly webinars. That's why we do them. We have the Market Road Pro in your hands, and we should be good to go also in 2019. And just as a last sort of 30 seconds, let me just say, first of all, thank you for joining today. But I think it's important for everyone to understand that if you've made money over the past number of years here in this raging bull market, don't think that it's going to be easy or as easy going forward. The market has shifted. It is continuing to shift, and you probably, unless you have a top-down process, understanding where the money is flowing on a sector level, you're probably going to have a very, very difficult time making money. So I look forward to seeing all of you in the next live session for the Market Road Pro. Again, you get 9 days access to that. That's going to start. That's going to start next week, next Wednesday, and then we'll do them every single week after that. So that's it, folks. Again, thank you so much, Jeanette and everyone. Belated Happy Thanksgiving, and I'll see you guys next week.